Economics. Welcome back to the program, Yusuf. Now, Ukraine has stepped up drone attacks on Russian oil refineries and export infrastructure. How significant are these strikes in terms of actual supply losses? And are markets overreacting or underpricing this risk?
As we can see, certainly it's a worrying sign, and the attacks of Ukraine on Russian energy facilities are increasing. Yet the impact of that on the market has been not so significant. In fact, over the past few days, since the start of the year, and in fact, even towards the end of the last year, we see the geopolitical risk premium on both the Brent and WTI quite diminishing. And today, in fact, we see Brent trading slightly above $60. In fact, it's likely that it's going to drop below $60 compared to WTI, which is already trading around $57. And one reason is because the supplies from Russia are still intact. We still see Russia pumping at least 9 million barrels per day. And of course, as a part of its commitment with OPEC Plus, I believe it's going to continue towards keeping the market supply, and in fact, even keeping their clients will supply towards the beginning and throughout 2026. So yes, it's a worrying sign, but the impact on the market is not so significant.
And Russia has been boosting refining capacity and rerouting exports under sanctions. How resilient is its energy sector at this stage of the war, and where are the real pressure points?
Certainly it's a smart tactic from the Russians. I believe certainly the impact on the refining capacity will have an impact on fuel prices within Russia. It may also impact the capabilities of Russia exporting products, but because the bulk production from Russia is not petroleum product, it's actually crude oil that is coming from oil fields. And that is, as we all know, it's being diverted to India, to China, and to some other consumers. So that means that Russia is likely to stay resilient. Of course, we don't know how the Ukrainian tactics will look like throughout the year 2026. We could also see a truce, ceasefire. This is likely. And if that happens, perhaps that could be another bearish sign for the markets moving towards the end of 2026. So I believe the situation continues to be highly uncertain, yet the geopolitical risk premiums continues to be slightly available.
And looking ahead, do you see oil prices staying stuck in the $50 to $60 range this year, or could broader geopolitical escalation, sanctions, or perhaps a demand surprise change things up for energy markets?
Well, I believe the fundamentals now continue to dominate the markets. Now we are in a market that is largely driven by fundamentals. There is a major story on a glut, and the IA sees that we might see a glut of nearly 4 million barrels this year, while OPEC sees a glut between 300 to 500,000 barrels per day. So I believe this is really what the traders are watching for. I believe that in Q1 we could see a downward pressure on the prices, but I think as we move towards the end of the Q2 and the summer, perhaps prices are likely to increase. And here the scenarios that could in fact send the prices up could be a first tight markets as the demand increased towards half of this year, and also the likelihood that the Fed, because we could see a new Fed coming in office, and that means we're likely to see a reducing interest rates. In fact, some scenarios expect that we could see 3 cuts this year, and this could reduce prices of the dollar or the index of the dollar, and that could send the prices slightly up. So I think the maximum, in my view, we could see the prices at $70 per Brent at maximum. I don't think we're going to see prices going really high for the whole of 2026. But some analysts expect that we could see a very tight markets next year, 2027. And that's really when, because really we have major underinvestments. And I believe throughout 2026, we could see prices at their best between $60 and $70. The bearish sign could be between 55 and 60.
Yusuf Alshammari, President of the London College of Energy Economics, thank you very much for your insights. When uncertainty rises,